So, ladies and gentlemen, I would like to introduce this breakout session. This is Credit Markets at a Crossroads. Thank you.
Good morning. Thank you all, everybody, for coming. What we'd like to talk today with the expert panel that we have is various aspects of credit growth, and from the viewpoint of the United States, Europe, emerging markets, distress. Do you approach it through the beta-oriented formula or alpha-oriented? Is there room for more of micro view toward credit as opposed to looking at it from a top-down basis? And those are some of the issues that we'd like to do. And in terms of just to introduce the topic from the US point of view, and if we can have slide number 19, please. What we show here is that you're looking at the total credit to GDP ratio in the United States being 1.5 times in 1980, and it rises to 3.5 times in 2012. The question is this a case of a more sophisticated credit market, or are we looking much more at a bubble in terms of a substantial increase in credit, a lot more than warranted by GDP? And hopefully you'll get a variety of views here. We have to my far right, Rich Byrne, president of Providence Equity Capital Markets. To his left is Tom Corcoran, who's president of Imperial Capital. Bob Kricheff, to my right, is the senior vice president and portfolio manager at Shenkman Capital Management. Brian Pinto is to my left. He's from GLG and is the chief economist for emerging markets. The focus is going to be more on the emerging market for him. And then Rob Ruberton to the far left, to my far left, a partner and senior portfolio manager for European credit at Apollo. We have asked the speakers to confine their initial remarks to just about 2 minutes each. It may seem more like assertions, but that's because we want to leave enough time both for questions here from the panel as well as from you in the audience. There are going to be microphones moving around, so hopefully you'll have a lot of questions. We don't want to end before the time is up. I'm going to start with Bob first. And one of the ideas is that you were approaching it, Bob, from a fixed income point of view. Talk about how you see the world fixed income and being the instrument of choice.
Sure. I think in the fixed income market right now, we've seen massive inflows of money. I don't think it's any secret that the debt markets have been an asset class of choice, particularly in the area that we're focused in at my firm in leveraged finance and the leveraged markets. And all that money that's come in has actually changed the markets a lot. For one thing, we've been able to push off maturities for almost all of the credits in the market, and this has probably whitewashed a lot of credit problems that actually exist for a lot of companies. It's also caused the leveraged markets to compress. If you want to put up slide 9, we put together the dispersion of spreads in the high-yield market since 2008, and this looks the same if you do it for yields, and it's really at the lowest level that we've seen in the last 5 years. And to me, this kind of means that you're really not getting paid a lot for taking extra risk within the market because the spreads have compressed so much. Everything seems to be moving in the same direction right now. There just is a much less lack of differentiation. And this is true within multiple asset classes, I think, too. I think everybody in the world is watching where interest rates go, and they're also watching what the Federal Reserve and other central banks around the globe are doing. If you wanted to put up the next slide, slide 10, you can see that because everybody seems to be watching the same things, correlations are actually significantly higher with treasuries than they've really been at any time historically. They really, quite frankly, look out of whack here when you think about it. There's a number of asset classes like leveraged loans and so on that typically have negative correlations now have actually become slightly positive as everybody seems to be putting on the same type of trade. One of the consequences of this, I think, is actually, quite frankly, that the Sharpe ratio for the near term has really become meaningless. I'm a big fan of the Sharpe ratio, don't get me wrong. It's simple and it's significant, and quite frankly, my firm looks good when you use it over time. But in the near term, I really think that it's just become meaningless because it seems like every trade in the market, and particularly in the debt markets, becomes a very crowded trade very quickly. And one of the big risks, I think, here is when you're in an environment with low dispersion and very high correlations and, quite frankly, a very low default rate, is that people really get away from being vigilant about credit quality. And we could be setting ourselves up for having some problems in the future when everything is going in the same direction, people are all putting on so much of the same trade, and you sort of get away from that vigilance, which is very important.
Thank you. Thank you very much, Bob. Tom, do you see it the same way? Is there a credit bubble that is taking place, or is there a shortage of liquidity? How do you see the market?
Well, slide 19 makes me nervous, not just looking at it versus GDP, but if you think about it, total U.S. credit debt outstanding since pre-crisis is up almost 30%. Dealer inventories are down 75% in the same area. And in the 25 plus years I've been in the marketplace, I've never seen the buy side be this much bigger than the sell side, and the sell side is not committing capital. And where they are committing capital is in the higher quality corporate credit. And so when you overlay CRD4, Basel III, Volcker Rule, I truly think that liquidity in this market has been masked over the last 2 years with a rally in rates and a rally in spreads. And when and if we go the other way, it's not going to be a credit event in my mind, but a liquidity event. With that many bonds, the transfer risk is to be very difficult, and dealers are not getting paid anymore to take on risk. And unlike the credit crisis led by Lehman in 08-09, this is not a Lehman-centric credit crisis. I think this has become more of a liquidity and transfer risk, which I think will blow out spreads and create a large dispersion between where single A corporates are going down into high yield and distressed.
Thank you very much, Tom. Rob, we had Leon Black speak at the Milken Global Conference in Beverly Hills earlier this year. He was going to sell everything that was not nailed down, and the spreads had come down. And how do you see it at Apollo, and what's your view on that?
Yeah. Thanks. It's interesting. You know, my colleagues and I are raising two very large funds right now. We're raising a very big private equity fund. We're raising a very large global credit fund. And it's always interesting to go into meetings with prospective investors, some of you I see out there, and tell you how great the opportunity is. You should invest money with us. At the same time, your chairman is saying you're selling every asset that we own, and if we're not selling it, then we're refinancing it some way. I think, to be fair to Leon, he has clarified his remarks to some extent to say that it is certainly true that we have been better sellers of assets in a market like this. If you think about, you know, what does Apollo do? What do our investors trust us with? It's to try to generate an outsized return, whether it's in private equity or credit. We're really an alpha firm. And in a market like this, with rates at all-time lows and high yield at 5%, very hard to generate outsized return. But that being said, we do think there's some fairly attractive areas of opportunity in spite of being maybe better net sellers of assets. Specifically in the world that I focus on in Europe, we think there's some very interesting opportunities to assist in the deleveraging of European banks. We think that's a decade-long trend. We also think there's some very interesting opportunities in lending, especially in some areas where banks have retreated from in Europe since the crisis.
Great. Thank you very much. Rich, let's go over to you. And from your viewpoint and at Provident, you have an alpha focus, and you're looking at credit essentially in a micro sense. How do you go about doing that from your New York base, and how do you see the situation?
Well, Sri, it's an interesting environment we're in now. A lot of the panelists have brought up some of the key issues that we're thinking about. We're actually extremely positive on corporate fundamentals, or fundamentals for corporates. You asked for some provocative statements. One, fairly negative on the beta trade. I think this point was brought out, despite being very positive about the fundamentals for corporate credit. That said, still think corporate's going to outperform equities. Rob brought it up, but I think in the middle market lending space, this is one way maybe to take advantage of some technicals that's going to get you a lot more yield. And since we're in Europe, I'll throw out another comment that the big next opportunity that I know has been touted, you know, around the street is direct lending, just that middle market opportunity for Europe. Rob would be interested if you agreed. Is we just don't see it. Just don't see the bank shedding assets. Just don't see banks stepping up their withdrawing from lending there the way they did in the United States. But the reason, Sri, to answer your question, the reason the way we think about credit here in the U.S. The reason the beta trade is very difficult is, well, let me first say on the positive side, we're in a 2%, 2.5% GDP environment, and I think the funniest thing about it is we're on our 4th anniversary of it going to be 3% next quarter. And for 4 consecutive years, it's not been 3% next quarter. In fact, I even just looked before preparing for this panel, just looking at some of the research we get from the sell side. And still, almost every economist has 4th quarter GDP growth, or 1st quarter at the worst, with a 3 handle in front of it. We've been banking on that for years. That's the basis for Fed tapering. So I'm still skeptical. And in a 2, 2.5, even 2 handle environment on GDP, that's where credit outperforms. Once you're in, in higher markets, I think you look back empirically at higher growth markets, and you see equities. Usually, that's where it takes over. I think the equity market has taken a down payment on those promises of that greater economic growth and has rallied. Equities will always trade off of forward earnings, and I think the forward earnings model is just a little bit off. Where in the meantime, corporate credit, you don't need companies' EBITDA to be dramatically improving. You just need it to be relatively steady, and that's the market we're in now. Unfortunately, there's no yield.
Thank you, Rich, very much. Brian, your focus is emerging markets. And again, we have had quite a turbulent period in emerging markets since May. Is this the end? There have been lots of people who say this is the end of the BRIC story, end of emerging markets. How do you see the situation?
Well, Sri, thank you very much. My first point is that clearly after 5 years of massive QE, you definitely have a regime shift in emerging market credit. And already narratives are developing about the disaster that's going to happen as QE gets tapered. But a very important point to remember in looking at these narratives and at the potential impact of QE tapering is that when QE began, developed market fundamentals in terms of growth, in terms of government debt dynamics, and the health of the financial sector were probably at their worst since World War II. And emerging market fundamentals along the same dimensions were definitely at their best since World War II. So one has to keep this factor in mind. Second, in terms of the regime shift that's occurred, there's a lot of focus on capital flows. But also one has to look at the regime shift in terms of prices, movements in exchange rates and interest rates, and also the composition of capital flows. And there, the recent sell-off in emerging markets that you alluded to, Sri, does provide some insights. My third point is that you're inevitably going to have some excesses in EM credit. Governor Stein reminded us in his February paper that when policy rates are close to 0 for several years and you have a lot of liquidity, people are going to take risks. Investors are going to take duration and credit risks. But I don't think we're back to a 1997. So this is not an Armageddon. This is not the end of the BRIC story. And that leads to my fourth point, which is somewhat more balanced, which is that now that QE has been postponed, we are not going to see a mad dash back into emerging markets. And the reason is that partly developed market fundamentals are improving, and I believe that there's going to be a lot more differentiation among emerging markets. Fundamentals are going to play a very important role. So the emerging market asset class is still very much alive. The BRIC story might get diluted because there will be other pretenders such as Mexico, maybe some countries in sub-Saharan Africa. If you look at sub-Saharan Africa as a whole, it might be the 5th or the 6th BRIC.
Great. Thank you. I'm going to, again, start getting your questions out. I'm going to start it out in terms of the great story in the Financial Times today. Jens Weidmann, the head of the Bundesbank, talks about credit growth in a different way. Banks being forced to purchase the sovereign paper of their own country and increasing the amount of risk. Anybody thinks that that is a risk in itself? When, Rich, for instance, when you are looking at middle market companies, you have this taking place at the side. And what does that do to your search for alpha as you go about making your investments?
Sure, that's a good question. When you talk about middle markets, which is one of the businesses that we're in, or direct lending, we've done the predominant amount of the lending we've done in the US. I made that thesis statement. It's partly a matter of reality. We just haven't seen the supply in Europe. But it also relates to just where we're comfortable, where we're credit analysts. We're not sovereign analysts. I think it's very difficult to be a sovereign analyst these days, even if we were. So in the US, it just feels like a credit story, and you're just evaluating a smaller company, bigger company. You're looking at market shares, margins, leverage levels, covenants, all the normal things. When you go into Southern Europe and some of the more troubled economies, then you start asking yourself the question, would I rather own the sovereign or a corporate credit? I mean, theoretically, I'm from the old school where your corporate credit would always trade at best to your sovereign ceiling. But we've had a tough time tackling that, and we've largely stayed away. I think on the more liquid markets, it's a more nuanced answer, because I think there are cases in Spain and Greece where you have the incumbent telcos and some other companies where you don't necessarily have to be positive on the economy, and it would be very difficult to be in some of those economies, to have a more positive thesis just based on the stability of cash flows, and especially when you look at debt maturities and credit ratios of a number of the names. I'm thinking of a name, for example, Ono in Spain, where they don't really have any debt maturities due anytime. It's a utility. It's relatively stable cash flow. Almost, you'd almost expect it to trade tighter than the sovereign.
Thank you, Rich. Rob, you talked about, again, the opportunities that are present. And when you talk about Europe, and this is again in contrast to the point that Rich made, are banks selling? Where do you go and make distress investment if there is no transaction on the other side?
Yeah, I think I agree with one of the points that Rich made around the lending side of this equation, but I might disagree a little bit with the opportunities to actually buy things from banks. And I think if you go to slide 6, maybe to make the second point first. Slide 6. There you go. This is a long process. And when you look at the quantum of assets held by European banks, the numbers we see are something on the order of 32 trillion. There's been about 3 trillion of deleveraging since the crisis over the past 5 years. We think there's another 3 trillion to come over the next few years. But the concept that you can plant a flag in London, walk into Lloyd's and say, hey, we're here, we have capital, please sell me something, doesn't really work that way. There's a lot of nuances in terms of what forces a bank to sell an asset. A lot of it is driven by the capital ratios at the bank. The easier it is for that bank to raise capital, the better their Tier 1 ratios are, the more losses they can take by selling names off their back book. And I think if you look in recent months in the blue line, you've actually seen an acceleration of that. You've actually seen more portfolio sales, more assets coming out of Spain, more assets coming out of Ireland, more assets coming off the UK bank. So I think that has accelerated. The fact that the credit markets are so much stronger than they've been helps that process as well, because it mitigates the amount of losses that the banks would have to take. The problem for a lot of hedge funds and people who do what we do is that the amount of corporate credit that's been sold is pretty low. Most of the opportunity is in commercial real estate, residential real estate, consumer receivables, shipping loans, harder assets, illiquid assets, assets that the proverbial 10 people in a Bloomberg don't necessarily buy. And so to participate in this process, at least we've found, you really have to build out a very specialized network across the continent, a very specialized network of people who understand some of the more esoteric asset classes like shipping loans, which can be completely illiquid, very hard to enforce on. And so we've certainly had to make that investment in resources, people, in order to participate in this process. But I do think this is a very long-term process. And if you look at the Japan example, it is quite literally a 10 to 15-year deleveraging process. The next point I would make is, I think it's on the next slide, where I do agree with Rich, on slide 7. The direct lending opportunity in Europe is one of the most overhyped, overused marketing pitches that I've heard in the past few years. And the way we approach it is the concept of Apollo raising funds to compete with a German bank or a UK bank in lending to good performing SMEs, it's just not possible. Our cost of capital will always be higher than their cost of capital. So it's very, very hard for us to compete in that space without significant leverage. And so that sets up a pretty dangerous game. What we've found is that if you go maybe off the beaten path and go into some of the more troubled geographies, like this slide shows in Italy, for example, or in Portugal, for example, the lending rates, the borrowing rates of those SMEs is much, much higher than it would be in the stronger economies around Europe. So from our lending activities, we're very focused on the more troubled geographies, more off-the-run situations, more stressed companies, where we can actually justify a higher cost of capital.
So you still have lots of opportunities in that area.
Yes.
Thank you, Rob. Brian, you said this is not quite 1997 in emerging markets, but 1997 started in a very quiet way. It was supposed to be just a Thailand problem, July that year, before it spread all over. What sparks it here, and how can you be so sure that this is not a big credit-dominated crisis in the making?
Well, Sri, the reason that this is not 1997 is simply that emerging markets today are very different from what they were in 1997. Let's not forget that in 1997, first of all, you had fixed exchange rates. In many of the emerging markets, you had unsustainable government debt dynamics. So the point is that after their own crises of 1997 to 2001, we know that emerging markets, in a way, got fed up of repeated crises of volatility, and they took matters into their own hands. They didn't really wait for the sovereign debt restructuring mechanism. They didn't wait for improvements in the international financial architecture. We all know what they did. I mean, they put government debt on a more sustainable trajectory. They moved to flexible exchange rates, built up reserves. We all know what they did. But really, what was the most impressive thing was that the perseverance with which they did this. I mean, they flipped their primary fiscal surpluses by up to 6 percentage points of GDP. And that's easy to do for 1 or 2 years. But they sustained this for several years. And so it's not surprising that by the time we came to the global financial crisis, they were much more resilient than anyone expected. And by 2010, everyone was talking about decoupling and emerging markets being the new engine of growth. But we now discover that we are truly in a globalized economy, both on the financial side and the real side. So this is not going to be 1997. The Fed hasn't started hiking yet. But that doesn't mean that we're home free. Could there be another Lehman or another, how many of you remember LTCM? Could there be another LTCM lurking in the wings? It's funny how
1998 followed 1997.
Exactly.
Yeah.
So it's funny how both the names begin with L. So just look for a highly leveraged firm, very macho, beginning with the name L. When I was at the World Bank, my boss, Ngozi Okonjo-Iweala, who's now the Minister of Finance in Nigeria, used to say, if only it had been Lehman Sisters, we would not have had a problem. But the point is that the point is that emerging markets today are a different asset class. They're a much more credible asset class. And so certainly the process of normalization of monetary policy in the US is going to take several years, and it's going to be a volatile time. And we can never rule out another major crisis, but I think the probability is very low.
Thank you. Bob, you were talking about the shortcomings of the Sharpe ratio, and yet you have to operate in that market. You have to make money for your investors. You have to get alpha. How do you go about analyzing it when all the correlations get to be so close?
Well, I think, again, I think as long as we're all going to be alive, the Sharpe ratio will still get used. And I think we'll go back to a cycle where the Sharpe ratio does get used. I think in the near term, we have, as I said before, we have everything so highly correlated that in the near term, it's become somewhat meaningless. To Robert's point about doing direct lending in Europe, all these trades sound like they're getting very, very crowded, whether it's, I think at the conference in California, I heard 8 or 10 people talk about direct lending in Europe. And so with all the trades getting crowded in fixed income, everything's going the same way, and the Sharpe ratio really does become very, very meaningless right now. And I think, getting alpha, you can get yourself into trouble if you're going for too much alpha in this market. If you're chasing a benchmark or chasing to beat a benchmark, you can really trip up. I think, particularly in the more levered asset classes and some of the higher risk asset classes, I think you want to really preserve capital in fixed income, and you want to produce a fairly steady stream of income, really, and that is a more successful approach. As a matter of fact, if you look at the Bank of America leveraged bond index going back from 1990 up till last month, you've gotten 9.29% of the return from interest income, and the total return is actually 9.19%. So you've actually underperformed. So I think it shows that over a long term, kind of taking a more conservative approach to those type of markets is actually a great way to perform. I think chasing alpha in some of these markets can increase your risk beyond what the return is.
So, for instance, if you look at the tracking error, and if you're looking at the high correlations, mean that you're not really picking up the extent of risk, truly,
yes.
And you would suggest being more careful on that side.
We would, especially as you're not getting paid for it
Exactly.
these days.
Tom, you are more concerned about the liquidity side, and I know you worry about Basel III, you worry about the Volcker rule. What do you say to people who say, we have to worry about that? We didn't worry about it in 2007, 2008. That's why we had the financial crisis. And is there a price to pay? The bank credit doesn't increase very much. Growth doesn't pick up because the focus is so much on safety that you forget the credit growth. And how do you get out of that rut?
Well, I would start, I think most people would agree that, going through the crisis of 08, 09, that both governments and regulators don't want to do what they had to do again and bail out banks. And since then, there's been a large push to have banks delever, have them raise more capital cushion, and securities that they are issuing, they want to be loss absorbing. So if you think about it, in a U.S. bank, you can either you could delever, you can issue common, or you can start issuing preferred stock. And as an example, the cost of capital has actually increased for somebody like a Citigroup, as an example. In April of this year, they issued a Basel III conforming 5% preferred stock, which counts as Tier 1 capital. 4 months later, they came back and issued a 7 1/8 preferred. So when you look at that, that's actually 11% pre-tax equivalent. That cost is becoming much more expensive to them, and you're kind of converging to what common stock would cost for a bank. So capital from banks is getting very expensive. And in Europe, we still need to see the final implementation of CRD4 and Basel III, but the contingent capital that these banks have to issue, started at 7, now it's 8. BBV just did 9%, and we all know European banks can either deleverage, issue common, or contingent capital, and now lower Tier 2 debt is bailable in. So capital, I think, is only going up for the banks. They're becoming better credits. But I think that goes back to having a lot of these banks look at their return on equity in their different capital markets divisions, and I think they shrink in that manner.
Great, thank you. Now we'd like to throw it open to the questions from the audience. Let us know by putting up your hand if you have a question, and wait for the microphone to come close to you. No questions from the audience?
If there's not an immediate question, I had
Go ahead.
I would love to add on a little bit to what some of the other panelists said. Specifically, maybe we could start with Bob's comment about dispersion in the market. I was very interested to hear your perspective on it. We have 2 slides that maybe just shed a little light from our perspective. Number 13, please. So one of the reasons the markets are correlated is because of this. It's hard to find fault with U.S. corporate fundamentals right now. The top graph is the default rate. You can see the red line is the average largely being dictated by the low line now. And that's 2.5%. And then the bottom is debt maturity. So you'd be guilty of malpractice as a CFO to have not taken advantage of the low interest rates that have now lasted so long that there's literally almost nothing left. So corporate balance sheets are very sound, And when you have an interest rate regime like we have now, you have this kind of fundamentals, and you have CNBC and Bloomberg TV and high yield market that's largely made up of mutual fund, and that fund flow number has got all the ADD attached to that, as does the ETFs. You just tend to get everybody to want to move the same way at the same time. Slide 17, if we could. So this is I just happened to have this slide here. I didn't know we were going to be talking about this topic. This slide I like and I don't like because I don't like it because it's inconclusive. But I think what it makes the point on correlation, and here's the correlation on investment grade and high yield, left and right of the chart, is we go through periods of high correlation, and then we go through periods of high dispersion, and then we go through periods of high correlation. And every time we go through a period of high correlation, we're convinced that, or high dispersion, we're convinced that it becomes a credit picker's market, and that's the time you can differentiate returns until, of course, the market all panics or rallies in the same direction. But I think we are, in fact, dealing with some improved, or I would say the systemic issues seem to be, over time, shrinking. And we are very hopeful that this trend line will flatten out a little bit, and we'll see a less correlated market where, credit pickers can get back into business. And it's tough to be a credit picker when you're, for example, short the unsecured, long, high duration end of a capital structure, and you're long the yield to call paper. There's a scare in the market, everything goes down. Of course you'd expect, of a really bad credit, of course you'd expect your riskier position to go down or gap down. I mean, that's the whole point. But Draghi will make a positive comment or something will happen, and because it's more liquid, or excuse me, a negative comment, because it's more liquid, the short end will be the thing that drops more, just defying logic, and that's frustrating.
Bob, Rich seems to still depend a lot more on the correlations, and he seems to have faith in it compared with you. How would you react to his point?
Well, I think a lot of his points about correlation were very valid. We're markets. We go through cycles. There's no question. We go through periods of tight dispersion and periods of correlation, and as he pointed out, we unwind. However, there can be some pain and suffering when you go from tight dispersion to wider dispersion before it becomes a credit picker's market. And I think you want to minimize, and I think this is going to be a long cycle as we move that way, but you want to minimize that pain when you go from a tight dispersion market or a highly correlated market to a wide dispersion market and a uncorrelated market. I think you want to, that's a painful move often in the markets and in your principal. I think the other point, there's no question that Rich's comment about the CFOs is correct. Everybody who has been able to, in the levered markets, who's been able to refinance, has been able to refinance. However, there are, and because of that, and because of the steroids of low rates and everything, and all the money that's flowed in, all these companies have been able to refinance. Some that probably shouldn't have been able to refinance, and there are still maturity walls that have been pushed off now to 16, 17, whatever. But some of these credits have really not solved their problems, they've just deferred their problems. And they may have to then address their problems in a much higher interest rate environment. I like to be bullish, and I hope the U.S. economy sees GDP growth and sees 3. But right now, I think if you average the last 4 quarters, we're at like 1.8 or something after the revisions. Those revisions can be nasty. And if we don't see a pickup in that, it's going to be very tough for some companies. Hopefully we're avoiding those companies, and everybody else is too. But it's really, in my mind, a little bit of more of a problem deferred for some of these people.
Thank you, Bob.
If I could just add,
Please do.
From the perspective maybe of a distressed debt buyer, one of the interesting corollaries to the topic about maturity wall and the ability of companies to refinance is that what's left of the companies who haven't refinanced, who haven't addressed their issues, are some pretty troubled situations. And there's nothing that we like better as a distressed debt buyer to make money the easy way. You buy a cheap piece of debt, it's trading at 60, 70 p on the pound, and the company refinances itself at par, and you look like a hero and you haven't done a lot of heavy lifting. The problem now is, if you're buying a piece of debt at 60 or 70 p on the pound, there's real problems. And you better be prepared to take ownership of that company. You better be prepared to go through a bankruptcy process, especially in some of the more difficult jurisdictions in Europe, because more likely than not, that company needs to go through an administration process to fix its problems. Making money the easy way in the distressed debt world is much, much harder now.
Good. Brian, you were since your focus is emerging markets, in credit, are investors making a clear distinction between some countries which are running deficits in the current account of the balance of payments? Think India, think Brazil, Indonesia. On the other hand, Russia and China, which have surpluses, have been let off relatively benign fashion. So is there more of rationality in the credit market, even when it comes to emerging markets, or how do you see it?
In fact, Shri, I would say that there is a reasonable amount of differentiation in emerging markets, contrary to what we've been hearing about the US credit market, for example. The clearest evidence on this is the sell-off that we witnessed once speculation about QE tapering began in May. Now, most people date this to May 22nd, but if you look at the rise in the US 10-year yield from the beginning of May, it really started on May 2nd when Governor Bernanke said that asset purchases could go up or down. And between May 2nd and May 22nd, we already had a 40 bips increase in the US 10-year yield. It increased by just another 10 bips for the rest of the month after the joint economic, the testimony to the Joint Economic Committee. Now, the point about emerging markets is that we saw that there were beneficiaries. And you know, if you try, there have been a number of academic studies, and including a paper presented at Jackson Hole on the global financial cycle in particular, and on the impact on emerging markets by Helen Ray, and her prescription is that they should go for capital controls. Now, the point that I want to make is that if you're looking at the impact of QE on capital flows to emerging markets, you know, the variables that people include as explanatory variables include the differences in growth rates, they include the differences in policy rates, and they include the VIX as a proxy for risk aversion. But there isn't any variable for EM credit itself, so it's hard to pick up that differentiation. At the same time, it's very hard to say that everything else was held constant during this time if you want to isolate the impact of QE. In fact, the only period, I've thought about it, and the only period you can do it really cleanly is over the 3 or 4 months after May when the speculation about QE tapering began. And there you do see some differentiation. We at GLG developed a sort of composite measure of total performance, looking not just at exchange rates, but also at interest rates. And we find, for example, that if you look from May 2nd to September 13th, that's a weekend before Larry Summers withdrew his nomination, you will find that the biggest sell-offs in order were in Turkey, Indonesia, Brazil, followed by India and South Africa. So it's not just the current account deficit. When you have this fear of capital flowing back to the US, it's the gross external financing requirements relative to reserves. It's also the policy rates. Countries that had negative policy rates were penalized more. Countries with overvalued real exchange rates also bore the brunt of the sell-off. In fact, Turkey is one that qualifies on all three because it has a very high gross external financing requirement relative to reserves. It has an overvalued lira in real terms, and it had negative policy rates when the sell-off began. So there is discrimination. What's comforting is that we didn't have a meltdown. We didn't have a systemic crisis. And in fact, there was enough time based on past episodes for one to have occurred, which makes me a little more confident that there was sufficient differentiation that even in a country like Turkey, where the fundamentals improved tremendously between 2001 and 2008, that we are going to see more hopeful times for emerging markets.
Brian, can I ask you a question?
Sure.
Do you think that greater monetary stability in the United States causes less money to flow to the emerging markets, that more money is flowing into the United States globally, into the US credit markets as we've started to see greater monetary stability? Is there a correlation at all, or you overuse correlation, I'll say relationship between the two?
Certainly, well, first of all, the studies that are available and some of the data that I've looked at suggests that portfolio inflows increased tremendously. Maybe total net or total capital flows may not have increased by as much. But you have to control for differences in fundamentals, and that's one thing that these studies don't do very well. Now, the VIX came down. That was an important factor, but the VIX is affected by QE. The moment you have QE, then certainly risk tolerance goes up, and people are more comfortable with taking on risk. So yes, there is a link. In fact, it's very interesting what Governor Rajan had to say, the new Reserve Bank of India governor at his press conference. He waited for September 20th. The conference was postponed because they wanted to see what the FOMC would do on the 18th. And following the no-taper decision, and he was asked this question, and certainly from the perspective of emerging markets, QE on the conduct of monetary policy has had a huge impact. Turkey has developed its own version of unconventional monetary policy to respond to it. So there's no question that it's had an impact on policy rates. There's no question that it's had an impact on flows. So yes, there is a strong link.
Since we are in the issue of QE, let me throw a question to all of you. We have had the Federal Reserve, which had $800 billion on its balance sheet on Lehman Day, September 15, 2008. And now we are 3.7. Before the end of the year, we'll be at $4 trillion. Global credit-wise, can you keep this going without the Fed ever having to sell the bonds back? Let's assume the taper goes to zero at some point in time, at about $4.5 trillion. Can you just stay that way and it doesn't affect the global market, or does it have to get corrected?
I'm not a macroeconomist, but it just doesn't feel like it can stay that way. I had the good fortune of being at a speech by Governor Dudley, who's the head of the New York Fed, last week. It was the 100th anniversary of the Federal Reserve. And he was really talking to Federal Reserve employees primarily who were there for the celebration. And he was quite blunt. He said, we're in uncharted territory here. And I think he sounded, the most cautious I've heard a Fed governor sound. So I think they realize they have to do something. I think they're going to probably do it very gradually. We've seen unprecedented action, not just by the Federal Reserve, but by central banks around the world, really. And I don't think that's a new normal. I think they have to unwind what they have done, if nothing else because of deficit pressure and trade pressures over time. But I don't think it has to be immediate.
Tom, in that case, where does the liquidity pressure come from? Because it looks like the world is awash in liquidity. Do you still have an issue like you see and a liquidity shortage developing as it is in the current market?
Well, it's a conundrum, right? Because as you approach $4 trillion, you even mention the word that we may slow down tapering, and it spooks the marketplace. But there's no clear way where you can get from $4 trillion to 3 to 2. And at some point, I think people wake up and realize that this is a major problem, that it's not kicking the can down the road, it's kicking the can down the superhighway, where it's going to take a very long and gradual process so the capital markets don't get spooked.
Right. The gentleman here has a question. Sir, if you can wait for a microphone to come to you.
Hello. As the portfolio manager of a single-family office with no analyst resources, now that I have you all up there, I've had a hypothetical scenario that now that I have you all up there, I'd like to pass on to you. What would ever happen? I mean, imagine that Bono just got the Nobel Peace Prize for getting the Western world, first world countries to accept third world countries, first world countries to accept third world countries to default on their debt. What would happen if America defaults on its debt? What's the consequences?
Very timely question. The government shut down a few hours ago, and October 15th, the debt ceiling may not be raised if the extent of animosity in the Congress is as great as it has been. So I think your question is very relevant. Anybody who'd like to take it up?
I could take it up.
Brian?
Well, first of all, I think America might have a technical default, but I don't think it's really going to stop honoring its debt obligations. I mean, this is a country where if you look at its debt dynamics, it benefits tremendously from its exorbitant privilege because the dollar is a reserve currency. It's one of the few countries where for decades you have had the real interest rate much less than the growth rate. So if you look at its debt dynamics, I see the default or the problem in America much more as a political dysfunction rather than a fundamental economic problem. Having said that, coming back to the question of QE and risk, I would in many ways consider many of the Eurozone countries, not just in the periphery, but also in the core, to be much more vulnerable than many of the emerging markets. And so I think there's a much bigger question of how the Eurozone is going to resolve its sovereign debt problem.
Thank you, Brian. There was a gentleman out here with a question. Sir, do you have a microphone?
Sri, while we're waiting for the microphone, I'll just add one other point. It feels like there's a step function of bad to worse. There's government shutdown. We hit that one. Then there's raising the debt ceiling. That's the next battle for the U.S. And then the third one is, could that ever result in an actual default? I'm not an economist either. Reading an interesting statistic, 91 times since the debt ceiling was put in place in like 1917 or something, we've increased it 91 times. So, I mean, I think a betting man would probably assume that that's, you don't listen to the noise, you just wait for the outcome. I think the interesting thing is I think we're literally having world sweepstakes for the most dysfunctional governments. Right, this week it's a horse race between Italy and the United States Congress. But to me, I think of this as noise. I feel like we've read the last chapter of the book. We've all peeked there. We know what it's going to be. And then it's just a question of whether we let ourselves get caught up in the crazy volatility in the market as it tries to handicap, eventually getting to that spot.
Rich, but to continue with answering the gentleman's question, the increase in the debt limit, do you even have to do that? Why don't? Because there is a budget which has to be approved by the US Congress. Once you've approved the budget, why do you have to make a point of even increasing the debt limit on top of that? It's almost duplicative.
I suppose. Again, I'm no expert, but based on current projections, we're going to be above the debt ceiling, and if that's not dealt with, that's theoretically we've pierced it.
Yep, we will lead to a default, at least temporarily, in terms of it. Sir, the gentleman here, please go ahead.
Thank you. You all been relatively, Måns Larsen from Mercuria Investment Management, by the way. You all been relatively positive over the underlying sort of corporate credit quality that we're seeing. And if you believe the first panel today, there's some positive views on the recovery in the global economy. But what I'm hearing from this panel is a negative on the credit beta trade, and negative on the direct lending opportunity, negative on the easy distressed opportunity in Europe, at least from Robert. Now, and also we talked about the backdrop of the risk of rates or end of QE, as well as the risk of having very tight spreads in the credit market, so the negative convexity if spreads blow out. So where do you see the alpha opportunity in the European or in the global credit markets? So where do you look for the alpha opportunities, either thematically or specific examples?
Good question. Rob, would you like to start off?
For me, there's a couple things I would say. Number one, in our business, you have to get off the main road. You have to get off the highway. If you're competing in the more liquid credit markets in Europe, if you're competing in the more on-the-run corporate distressed, it's very hard to generate an outsized return in the markets today. So everything we're doing as a firm is trying to find ways to get off the highway. How do we go into an underserved market, a less competitive market, trying to find esoteric industries that aren't very well trafficked in? I'll throw out an example, distressed retail. Distressed retail, banks run for the hills when a retailer starts to get into trouble. The market is generally negative on retail. It's if you ever go to a CLO conference and someone will ask, what is your least favorite industries? And they always raise their hand and say, retail, we hate retail. We like that. We like people who are scared. We like people who are getting out of markets, who are getting out of areas, because that's what creates the opportunity for us to find a mispriced asset. And in a world where a lot of assets that we see aren't mispriced, you have to find some of these more niche areas to generate real return. So I would say difficult geographies, number one. more difficult industries, number two, as ways that we think we can generate some return.
So you're going to have a benefit and a value added from knowledge, from market imperfections.
I think that's right, and a willingness to employ the resources, the talent, the industry experts that you need to actually be successful in some of these areas. Willingness to actually spend money on the problem. It's, we're very big in energy lending right now in the US, but the concept of me or my team, who I think are very smart people, making loans against reserves in the ground in the Gulf of Mexico is very challenging. You need to employ people on your staff that do this for a living, that have done lending into the energy space for 20 years, that have an engineering background, that can look at a reserve report and say, well, here's how much the resource I think is in the ground, so here's how much we're willing to lend against it. You need to make that investment in people to do some of these harder activities.
Thank you. Rich, you had.
Yeah, thank you. That's a great question. Thanks. We all thank you as panelists, because this is the perfect layup to tell you about how we go about finding alpha. So I'm sure fellow panelists will want to respond as well. We think about this all the time. Being positive on the underlying fundamentals, just the yield so tight, is a good quagmire. It's like a high-class problem. And it also gives me excuse to show the last slide that I had prepared, which is number 16. So you mentioned the middle market lending. Europe, tough because of lack of supply for the reasons we discussed, and maybe, again, that's a little more nuanced. Maybe there is some supply some places, but it's certainly not an avalanche as the market has been hyped. I agree with Rob. In the US, different story altogether. Chart we compiled on the left is banks used to be in the middle market space. They used to lend to corporates. I used to work at a bank. It was one of the most profitable businesses we had. It was small because the companies are small. But post-crisis, pre-crisis, 69%, post-crisis, 17% of middle market loans came from banks. That's mezz, senior debt, wherever it theoretically was in the capital structure, more on the senior side. That gap is enormous. That's about $50 billion a year. And on the right side of this chart, you can see a giant maturity bubble for a lot of these same middle market companies that were issued 5, 6, 7 years ago. Those maturities are coming due now. Supply-demand imbalance. Big liquid markets have enormous record fund flows, and littler companies, where the banks aren't participating, actually has the exact opposite issue. So that's an example of doing your credit work. Small companies, a little trickier than big companies, but doing your credit work and trying to get, in many cases, 50% to double the yield. Another place that we've looked for alpha, we run a long-short credit strategy, completely taking out the beta of the market and just thinking about capital structure ARB within credits, best longs, best shorts, paired trades, that type of thing. And the third for us is, and I know some of the panelists are as well, we're CLO managers. Maybe it's not the ultimate create alpha, but it certainly takes the interest rate component out. And you're also connected now with a tremendous technical benefit, which is the creation of CLOs. And I'm sure that spigot will end someday, hopefully not badly, like it did last time. But the fundamental premise of CLOs is, despite the volatility in the market, which I know can be very painful during crises, it's really contingent on defaults on the underlying loans in the portfolio. So as long as you stay close to where you're modeling these things, I mean, CLO returns have come down, but you're insulated against rates, and theoretically your CLO equity and your tranche, your waterfall tranches above that earn excess returns. So that's how we're approaching it.
And thank you. Go ahead.
I was just going to say on the CLOs, obviously the key to successfully structuring a CLO is avoiding problems. And also, I think when a lot of really more CBOs got into trouble before, I think there were structural issues too, where you had fixed rate assets versus floating rate liabilities. And I think that obviously with the CLO product, that's not the case. And as long as you're constructing it with the proper spread and the proper equity cushion, and to Robert's point, have a lot of good people doing the credit work, the equity tranche in there can be very attractive over time. As well, but I think the last cycle, the structures were extremely different.
Thank you. We are coming to the end of our period, but Tom, would you like to try answering your question where you would see the opportunities in the next couple of years?
Sure. To the gentleman's question, obviously the market's changing in Europe, where it was more loan-centric and less high-yield-centric. As we continue to see the shift in banks lending less and less to non-financial corporates, I think, and you look at the wall of maturities of 230 billion coming over the next 2 years, with these corporations will not be able to get the same rates as they had in better times. As an example, we just brought a new issue for Soho in sterling for 115 million pounds, which to my knowledge is the smallest public high yield deal done in sterling. Goldman before that bought Study Group, and I think you see a lot more of these issuers that will access the high yield marketplace in Europe and not go the loan route because banks don't want to loan to them. And getting back to picking the right credits, I think is where you create alpha in the market.
Great. Well, thank you all very much. You've been a terrific audience. Thank you for your questions and thank you for your participation. Have a good day.
Thank you to the panel. Ladies and gentlemen, the next breakout sessions will start in 15 minutes. Please consult your program for full details. Coffee and refreshments are available on each floor. Coming up shortly on level 29, here in the main plenary, is Reviving and Recapitalizing Europe. On level 30 is Investment Opportunities and Risks in Africa. That's in breakout 1 on level 30. And Disruptors, Innovators and Entrepreneurs, also on level 30 in breakout room number 2. Coming up in about 15 minutes. The staircases at the back of the room in level 29 opposite the stage. The left-hand staircase is a staircase with no view, and for those of you who don't suffer from vertigo, please take the view from the right-hand staircase.